Dividend growth investors, bonjour. Welcome to this channel where I help you invest with more conviction so you can enjoy your retirement. And today we are going to talk about when is it the right time to sell Enbridge. Don't worry, this is not a video about bashing Enbridge, but rather to explain how to look at your portfolio, manage your stock, and determine when it's the right time to buy or sell a stock, depending on your strategy and your point of views. So to make up that story, I used to be a shareholder of Enbridge. I bought it in 2017 and I sold it in 2023. I decided to do that after a deep review and realizing a few things. So today we're gonna see why I did that, which stock replaced it in my portfolio, which was CCL Industries. So kind of like replacing a high yielder with a low yield, high growth stocks. So we're going to explain that as well. But first, let's go back in time and look at what the dividend triangle looked like in 2017. As you can see, the company saw some price weakness over a few years. There was a lot of political battles with regulators. Enbridge had major projects, so making new pipelines, maintenance of older one as well. So big capex plans there, but it was tough with regulators. So the stock price was a little bit lower, while revenues and earnings were not that bad. And I thought, you know what? I'm going to buy on price weakness. Back then, the company increased its dividend by 10% per year and had plenty of distributable cash flow per share. So that was the main metric to look at. It's kind of like a homemade calculation metric by Enbridge, but to show you it's closer to the cash flow available for the company to distribute as a dividend and looking at earnings. But even then, everything was looking very fine and it was a great opportunity in 2017. Fast forward today, what we see is the revenue growth is slowing down. The earnings per share is kind of like going up and down, but pretty much stable. There's a lot of debt. We're going to see that in a second. And most importantly, the company started to slow down its dividend growth policy. So instead of going for 10% a year, they decided to slash it down to 3% a year. So slowly but surely, Enbridge became kind of like a deluxe bond. So a kind of stock where you don't expect much in terms of stock price and it will pay a solid yield. So nothing wrong about the company per se, but the growth phase kind of doesn't exist anymore. The dividend growth doesn't exist that much, just barely meeting inflation. And for those reasons, I did not want to hold a deluxe bond in my portfolio. I rather wanted to hold a low yield, high growth stock, something that will generate a lot of income. So when I bought Enbridge back in 2017, the yield was a lot lower, the dividend growth was really stronger, and most importantly, the debt was a lot smaller as well. And as you can see, it is like an never-ending story where the debt keeps on going up and the company doesn't seem to want to stop at any time soon. So they're making more acquisition this year. They issued shares already. They got a little more debt already. And all of that debt, if you watch my video on Bell and Telus last week, and if you haven't, well, I mean, you have to give me a thumbs up and you have to subscribe to the channel to not miss any videos. But long story short, capital intensive companies are having a hard time with their interest charges, and that keeps on growing. So if Enbridge is not able to massively show a lot of growth, well, at one point they're still going to become a slower, mature business, which will have not much cash flow to increase their dividend. And that's what we saw with a 3% per year increase policy over the past few years. Nothing in the future tells me it's going to be better going forward. So with those type of deluxe bond, it's not the end of the world to have them in your portfolio. I know that it feels good to get the income, but at one point, just do that moderately. Like, don't just go crazy on those high yielders because you're still putting your portfolio at risk. And if there's anything that goes wrong with the dividend, well, then everything, like your whole plan, investment plan, will go downside. Unfortunately, the stock price will decline, the revenue will decline, and you will be left with not much to do. So instead, I decided to invest in CCL Industries. Kind of crazy because I went from a yield of like 7% to a yield of 1.6%. I wanted to show you the difference in terms of total return. So that's stock price plus the dividend payment. So Enbridge barely making it, so up 2%. If like that is as of May 6th. Not too long ago, they reported their earnings on May 10th. They reported good earnings. It was better than expected. The DCF, the distributable cash flow, was up 8% to 3.4 billion. Since they issued more share, the DCFs per share was up 4%, but still quite interesting. That's still along with the guidance that the company reported. So it was overall a good quarter. The stock price is slightly up since then, but CCL Industries stock price is also up. So even if I had done the stock price chart yesterday, it would have pretty much be the same. So 2% for Enbridge, roughly 10-11% for the S&P TSX, and then 18% total return for CCL. What is interesting is when you compare just the stock price. So as you can see with Enbridge, the stock price is not even as the same price when I sold it. Long story short, you get the dividend and you don't get anything out of that. This is what I mean by a deluxe bond. So it's slightly better than a bond. So you should expect some small capital appreciation and the dividend will increase as opposed to a bond where the interest is getting paid but you're not getting anything else. So just a little bit better. But just be careful because while CCL Industries stock price goes up and down, was relatively volatile. They had a pretty strong quarter not too long ago. That's why it shows a big jump. But throughout most of the time, it outperformed Enbridge. Now, it's only a little bit more than a year. I don't go crazy about that. I just wanted to show you the difference because the real impact on the portfolio will be done in 5, 10, 15 years, not this year. The reason why I sold Enbridge is there's always a correlation between your investment thesis, so the story, why you have a stock, and the numbers. So back in 2017, the story was there is some price weakness due to political and regulator problems, and Enbridge is used to that. It is a very strong company, growing its dividend by 10%, strong management team, and they know how to handle regulators. Fast forward 7 years later, the dividend triangle is weakening, the dividend growth is weakening, the debt is increasing, and I don't see that great growth I saw 7 years before. So I sold at a great profit. It was perfect like this. And then I'm moving on to something that for me is looking a lot safer. And yeah, you heard me, it's a lot safer. And not even at my age. If I was 85 today and depending on income from my portfolio, I would feel a lot more comfortable with a company that is thriving and well diversified. So let's just end this video with what CCL looks like, just to give you an example of what I consider to be a safer bet than Enbridge for my retirement. So CCL Industries, well diversified across 43 countries, North America, Europe, emerging markets, 6 continents, plenty of employees. We have an amazing business here. The company is making most of their money from packaging. So specials packaging, labels with Avery, RFIDs as well with Checkpoint, and some banknotes and other products with Innovia, but most of it is packaging. So which is great is repetitive purchases with packaging and labels, great diversification there. They grow by acquisition also. So that's another point that I love about CCL. And that ensures a more stable type of business where you have plenty of products, a lot of repetitive products, doing business across the world, which is really great, and it's not going to be affected too much by commodity prices. And when you see the dividend triangle, when I bought in 2023, the revenue were going up, the earnings were going up, and also the dividend was going up. It's actually a long-term dividend grower. And as you can see, while the earnings has slightly declined at the end of 2023, for the rest, it's still looking good. The latest quarter was great as well. The market can see the value in CCL Industries that will continue to thrive going forward. And even if sales and earnings are slowing down, if the economy slows down a little bit more, with a long-term perspective, we're still going to need some packaging for a lot of products, and it's not going to change anytime soon. Same thing with labels, and CCL continues to have a very solid balance sheet that enables them to making more acquisitions. If you want to learn how to find great companies like this, you can register to my webinar that will happen next week on May 30th. It's at 1 p.m. Eastern time. If you cannot make it for the live event, still register to get the replay. If you're watching this after May 30th, click on the link to watch the replay directly. I'm going to talk about the buy struggle, the sell struggle, and how to invest with more conviction. So getting a clear roadmap to get where you want to be and invest without any remorse. All right, guys, give me a thumbs up if you have enjoyed this video. Don't forget to subscribe to my channel to not miss my next video on next Thursday. And until then, don't forget to stay invested.